Yeah, the whether it has to be in the physical world, I think, is a question. For example, I think I have a Trezor ledger, whatever it's called. I got it a while ago. It's like I said before, I was asleep for Bitcoin, and I put when I had like a full Bitcoin, I put it on the thing and said, "Well, I'll just keep that on there and never touch it." That's a very different impulse than when it's just in your Coinbase account.
Today, we're diving into a fascinating conversation I had with Will Tanner from the American Tribune about wealth preservation and why having your Bitcoin in your own custody is absolutely crucial. Will brings a unique perspective on how the wealthiest families in history have maintained their wealth for generations and what that means for Bitcoin holders today. In this video, we're going to explore how the simple act of putting your Bitcoin on a hardware wallet can completely change your relationship with your wealth. We'll look at real historical examples of families who've preserved their wealth for centuries and learn how their strategies apply to Bitcoin today. What's particularly interesting is how Will connects traditional wealth preservation techniques to modern Bitcoin custody. And trust me, you're going to want to hear what he has to say about Americans' bad habits when it comes to holding on to wealth. Before we dive in, if you're enjoying this type of content, hit the like button and subscribe to the channel. This is just a small portion of my full conversation with Will on the TFTC podcast. You can find the link to the full episode in the description below. What you're about to hear is a fascinating comparison between holding Bitcoin in your own custody versus letting someone else hold it for you. As someone who runs 1031 and works with Bitcoin companies every day, I've seen firsthand how important this concept is. Well, Tanner is about to explain how the mere presence of friction in selling an asset can lead to better long-term decision-making. And this isn't just theory. It's something that's been proven throughout history.
Yeah, the whether it has to be in the physical world, I think, is a question. For example, I think I have a Trezor ledger, whatever it's called. I got it a while ago. It's like I said before, I was asleep for Bitcoin, and I put when I had like a full Bitcoin, I put it on the thing and said, "Well, I'll just keep that on there and never touch it." That's a very different impulse than when it's just in your Coinbase account or whatever. And you can say, well, I want to sell it or I want to take out debt based on this Bitcoin, which is probably a horrible idea, et cetera, et cetera. But you can do it, and the impulses do it because the button is there. You can do it if you want. Whereas if it's on a thing where there's just even any friction between the asset existing in your possession and your ability to sell it, probably for a consumer good of some sort, that's a much better impulse because it's going to last.
What Will just described is something that I see all the time in the Bitcoin world. When you have your Bitcoin on an exchange like Coinbase, it's just too easy to sell. It's like having cash burning a hole in your pocket. But when you move it to a hardware wallet, you're creating what we call technical friction. This isn't just about Bitcoin, though. It's about human psychology. Think about it like this. If you have to go through 5 steps to sell something instead of 1, you're more likely to think twice about it. You might ask yourself, do I really need to sell this? This is exactly what wealthy families have done for generations with land and other hard-to-sell assets. They make it difficult to liquidate their wealth on impulse. In Bitcoin, we've recreated this concept digitally. When you put your Bitcoin on a hardware wallet, you're essentially creating your own digital estate that requires deliberate action to access. The beauty of this system is that it combines ancient wisdom about wealth preservation with cutting-edge technology. The hardware wallet becomes your digital fortress, not just protecting your Bitcoin from hackers, but more importantly, protecting it from your own worst impulses. This is particularly crucial during market volatility when emotions can run high and lead to poor decision-making. Now, we're going to hear about how some of Britain's wealthiest families managed to keep their wealth through generations. This is particularly relevant when we think about how to preserve wealth in the digital age, and the parallels to Bitcoin custody are striking.
A good example is the Marquesses of Salisbury. Lord Salisbury was famously the prime minister for Queen Victoria. His great grandson, I think, the current Lord Salisbury, is still the leader of the House of Lords, or at least was until recently, and is one of the more conservative right-wing members of the Lords. So it's interesting. They survived and they're still wealthy and they're still acting like aristocrats rather than having to scrounge around for work doing whatever. So if you look at why they survived when the others failed, it's really because they had an asset that they had a reason to hold on to and was difficult to sell. So while others could just sell stock and a business that was once the family business, but they had no attachment to, the Percy family had owned this estate since William the Conqueror or since any of the Plantagenet kings. So they're not going to sell any acreage.
This is such a powerful example of why having sticky assets, things that are hard to sell, is crucial for maintaining wealth across generations. The Percy family he's talking about has kept their wealth for nearly 1,000 years. That's not because they were financial geniuses, but because they owned something they couldn't easily sell. Their land wasn't just an investment, it was part of their identity. And this is remarkably similar to what we're seeing with Bitcoin today. When people truly understand Bitcoin, they often develop a deep connection to it that goes beyond its price. They see it as something to hold on to, just like these families viewed their land. The key difference is that while land is physically hard to divide and sell, Bitcoin requires us to create that friction ourselves through proper custody solutions and, more importantly, the right mindset. And what's fascinating about this historical example is that it shows how the wealthy have always understood that the ease of selling an asset is often its biggest weakness. In my work at 1031, I've noticed that the most successful Bitcoin investors often create their own versions of this aristocratic mindset, treating their Bitcoin holdings as a multi-generational asset rather than a trading vehicle. You're about to hear how different cultures approach wealth preservation differently and why that matters for building lasting wealth. This hits particularly close to home as an American running 1031, and it highlights some crucial lessons for Bitcoin holders.
Things out, particularly with the high taxes they have there. But they did it, and they succeeded, and they overcame the death taxes. And I think the reason is this just idea of purpose and continuity, and the idea that selling is probably a bad idea because you're never going to get it back. So you need to find a way to make it work without doing that. So it's an interesting paper, and they succeeded in it, which I think it's very long-winded. I've been talking, but the Americans are really bad about that. Americans always sell stuff. My great-great-grandparents were in New York in the Gilded Age and were in the New York 400, lost everything in the Depression because they just sold it and spent it. Now I'm working, so annoyed. But it is a joke. But yeah, so Americans are bad about that in the way that the British aren't.
This really hits home as an American investor. We have this cultural impulse to always be trading, always be moving money around. Look at the average holding time for stocks on the S&P 500. It's dropped from 8 years in the 1960s to less than a year today. This is exactly what Will's talking about. The British aristocrats he mentions built their wealth by holding on to assets, while Americans often try to get rich through constant trading and speculation. When I think about Bitcoin and the companies we invest in at 1031, this lesson is crucial. The most successful Bitcoin investors I know aren't the ones trying to time the market. They're the ones who've decided to hold for the long term, treating their Bitcoin like those British families treated their land. They understand that wealth preservation isn't about making quick trades. It's about finding something valuable and holding on to it through thick and thin. What's particularly interesting is how this relates to the modern financial system's emphasis on liquidity. We're taught that being able to sell quickly is an advantage, but history shows us that the opposite might be true. The ability to resist selling, whether through physical constraints like land ownership or self-imposed constraints like hardware wallet custody, might be the real key to building lasting wealth. What we've learned today about wealth preservation and Bitcoin custody is just scratching the surface of my conversation with Will Tanner. I want to hear from you. What's stopping you from moving your Bitcoin to a hardware wallet? Leave your thoughts in the comments below. If you found this valuable, you can catch the full interview on the TFTC podcast. The link is in the description. And if you want to see more content like this, hit that subscribe button and like the video to help more people find this information. Thanks for watching, freaks.